Now we're going to turn to Asia, one of my favorite topics, going through some of the different components of what is happening in obviously two of the biggest countries for the growth metric of not only just energy, but food and where a lot of our products originate. There's a lot of things to talk about. But before that, I just want to mention on Europe, where when we next week we'll go through PPI. They've continued to see inflation as well on a core side. There's not a whole lot outside of, they are going through a reopening. We covered that in the EIA show, so I won't rehash it, just because there's a lot to dig in here in terms of some of the different capacity moments. So when we look at the S&P commodity spot index and we look at the deviation from trend, we've shown this before, and it continues to move out of whack versus where some of the trends are. And China has now released, or I should say sold, commodities from their national stockpiles to try to bring some of these inflationary costs under control, specifically across commodities. I mean, coal is out of control again. LNG prices continue to drive higher, pulled higher by coal. Plastics, you name it, we continue to see this perpetual move up. And then when we look at the average over the last few months, if you go through from 73 through 18, here's how far we've deviated from the normal. And when we talk about oil and refined products, and we talk about this extensively in the EIA show, so I won't waste too much time on it. But when you think about 2018, we went from this price to the 50s. And when we start looking at some of the underlying components, it's very interesting to see, okay, well, how quickly are we going to see some of these drawdowns? We've seen these continuous builds in gasoline. We've seen some draws in distillate, but this is going to be some of the shift. And we've seen some capacity shortfalls just because people are like, look, I'm not paying this price. And you're starting to see the consumer reject some of these increase in prices. And that's something that I think is important to appreciate when we look at refined products and refined product demand as those prices keep going higher. And this is going to lead back to India specifically, where we've seen those prices hit new records. So when we look at those credit impulses, and we'll look at this in a different way in a few moments, you can see that when we look at just what is coming, those new orders continue to fall. Credit impulses are shifting down again. And when I look at this underlying move, this is where I think we see some of these pressures. And again, China is such a huge part of the market. When they buy 14 million barrels a day of crude. Any type of reduction is going to be felt throughout the system, which we've seen in spreads. India's come back a bit, but as we start to get into more of a normal market where some of the issues that have been brushed aside come forward again, what is that going to do for that long-term demand cycle? And by long-term, I mean over the next, the next 6 to 12 months. So then when you look at India wholesale prices, looking at what's happening in India in general, wholesale prices have made a new high going back to 2012. And this is where, the prices and the deviation between wholesale prices and consumer prices are so wide, and they're starting to make up ground. And there's still way more to go, and you're going to see these prices continue to get passed through, or I should say cost to the prices in general, as India reopens from their lockdown. Some of their states are starting to reopen. You're starting to see some of that acceleration. That will continue to see some of this transfer of pricing. And that's when you look at the wholesale price year over year, missed estimates by a small amount, still moving in the wrong direction in terms of pricing. And now CPI is back above the top level of 5.56%. And that is going to become a much bigger issue, especially when you look at trade balance. Trade balance, trade continues to be strong. Exports were strong, imports were strong. But when you look at the cost of exports, imports, that just continues to show that there is more to come on a wholesale price and the CPI level. Which is why when you look at bond buying to keep liquidity surpluses and rates low, it's going to be difficult when you start looking at the 1-year marginal cost and the weighted average, because they're trying to keep these rates down, but you have this inflationary push, you have this reopening push that is going to work against you and cause this essentially trying to operate. And at some point, it's either going to be a monetary shift or a fiscal shift, and it will most likely be a monetary of either a cooling off of bond buying, an increase in rates, because they have to try to maintain that fiscal stimulus. And last year they increased taxes on petrol, and now with record petrol prices, are they going to pull that back? Even though they're running a record deficit, and that it's a record deficit, even when you include what they've already spent, when they include the revenue from these taxes, which makes it very difficult to see them pull that out. Which is why when you start looking at the GDP side, I've said it from the beginning, I'll say it again, I still think the market is well over their estimates for where India is. I think they come back from a lockdown. I'm not saying they don't, but remember, their diesel consumption was never the same even before the second lockdown. And it never really got as low, but this is where that perpetual issue in terms of inflation, what can people tolerate, remains to be front and center, and is going to weigh on just what kind of activity do we see out of these very important growth markets for not only just the US, but the energy markets and just the global economy in general. So when we look at inflation surges, so just to give you an idea of where things sit. So consumer price inflation jumped to 6.3% year on year in May from 4.2% in April, which is what we were talking about. Consensus called for 5.4%. So again, they're surging above expectations. And given where wholesale prices are, where import prices are, export prices, this is not going to stop. And the other issue is it was a broad-based increase in pricing. So the increase was broad across food and fuel prices climbing. The core rate also rose sharply. Food inflation reached 5%. High transport costs and fuel prices probably contributed to the increase. Core inflation hit 6.2%, up from 5.2%. This reflects companies passing on higher costs to consumers from rising fuels, virus-related expenses. On a month-on-month basis, core prices increased 1.4%. This is not just base effect, and I can't stress that enough. As you can see here, that they're going back above, and just given the breadth and depth of the inflation, the government raised fuel taxes by roughly 20% on domestic fuel prices in May 2020. A 10% increase in fuel prices raises CPI inflation directly by roughly 25 basis points and indirectly by around 50 to 60 basis points. Will they back that out? My short answer will be no, but it doesn't mean that this can't be put back on the table to try to adjust some of those flows and try to bring things under control. And here's where you can see that pretty steady move: food and beverage, meat and fish, fats and oils, tobacco and alcohol, fuel and lighting, clothing, miscellaneous. All of these things was across the board increases, which are going to weigh on just what that inflation looks like, what that recovery becomes on the back end of it, because emerging markets don't have the same capacity to borrow, don't have the same options that the U.S. has, doesn't have, or developed markets in general, which is going to be a weight on their shoulders because their costs are going to go up. Now, when we turn to China, and we'll break these out in different pieces. Retail sales year over year down, missed estimates were expected at 14, came in at 12.4. Retail sales year to date were expected at 26.3, came in at 25.7. Industrial production expected at 9.2, came in at 8.8. Industrial production year to date, again, missed estimates to be at 17.8. Fixed assets, 15.4, property investment. Essentially, it was a miss across the board. There was not a single thing that met survey estimates. And more importantly, the May data on the consumer is concerning, because if you remember, we talked about it in April and the beginning of May. May was the CCP said May was going to be the consumer month. They were incentivizing companies to do big sales and promotions, and it was all going to culminate in the most recent holiday this past weekend, and this is the outcome. So this is with massive incentives. This is with sales and trying to get people to do more. And it's just people are, especially in China, we're not seeing that local consumer come back in any meaningful way. And not to say that the consumer was strong pre-pandemic, but they continue to be weak and continue to be an overhang, which is when we start looking at, again, that materials relative change to China credit impulses. The credit impulses are rolling, and that's where, as the consumer weakens, as inflation picks up, as they try to manage those levels and manage those commodity prices, as they sell from internal storage, that means that then the companies are going to buy less from external. They're going to import less, which is going to bring down, because it's going to leave more product on the coast, in the water. So then when you look at the aggregate, so let's look at at the financial system in general. So they continue to pull down the total money supply. So financing aggregate, we're flat month over month. New loans flat month over month. Money supply, you saw a little bit of a tick up on M2, but the credit impulses are still driving down. So you can't go, obviously you have to manage this in a certain way. So you can't just go perpetually to zero. And you had a big spending month in terms of May. So you wanted to make sure that you had a certain amount of liquidity available in the market to have this type of increase in spending that was expected. But now that we're to the other side, we expect to see some of this additional drainage of M2 coming out of the system. And this is kind of showing you where it is. So manufacturing PMI, new export orders are rolling over. And that's where exports, as we've talked about, exports are going to continue to fall. So not only do you have a huge backlog of export orders, if you have a backlog of export orders, why am I going to give you more work if you can't make the work that we've already done show up? So again, you're seeing this pressure point coming down, which will drain out and bring down some of these underlying components. And thinking about that in some specific context, because let's put context around everything we've talked about. China has seen a two-track recovery from the pandemic. Investment and exports have been strong. Consumption has lagged. In China, China wants that consumption. Again, dual circulation strategy. But when you look at the Dragon Boat Festival, according to the Ministry of Culture and Tourism, total tourism revenue over the 3-day holiday was $29.43 billion. That's only 74.8% of pre-pandemic levels. People are not spending. It gets worse. Those numbers are particularly bad when you remember that international travel is basically a no-go. Everybody's stuck within the country, yet people are essentially saying, I'm tired of traveling locally. I don't want to. I'm done. I'm going to sit home. I'm going to save my cash, and I just don't have any interest in spending. And this is, again, how much of this can be baked into what is going to happen in the U.S. And obviously, the China is tightening. We're easing. So it won't be the same, but there has to be some consistency with what is the consumer going to do. The U.S. consumer has always been very robust versus the Asian consumer, and that's not going to change. But how much of this is going to bleed into increased prices, a decline in just the global economy, because China is the second largest economy in the world, and the consumer is not showing up on a continuous basis. Investment is slowing. Liquidity is trying to get pulled out. And again, these are things that are going to lead to slowdowns. And this is just showing the underlying data in a different way. So industrial output also growing at slightly weaker paces, because you're seeing your industrial output, you're coming back to, and you're really now below your run rate prior to COVID. So industrial production rose 6.6% in May. On a 2-year average basis, which strips out the impact of last year's pandemic, while retail sales grew 4.5%, about half of its pre-pandemic rate. Investment in fixed assets such as property and land was 4.2% on that basis in the 5 months through May, according to the National Bureau of Statistics. All of the figures were roughly in line with the previous month, suggesting the economy growth has stabilized but not grown. And that's where we continue to see there's no inflection point. And everything that we're seeing in terms of future growth, and there's just, given the fact that this is May, which again was a promoted month, and you could barely get anyone to come out. So China records 89.136 million tourist trips in the Dragon Boat holiday, up 94.1% from a year ago, and recovering to 98.7% of pre-pandemic levels. Tourism revenue rose 103.7% year over year to 29.43 billion, about 75% of pre-pandemic. But so that's people traveled, didn't travel far. So again, leading into energy consumption reduction, all of these pressure points that keep coming back. China recorded 462.8 million yuan sales in Dragon Boat holiday, June 12th through 14th, a multi-year low at the box office. According to ticketing platform, box office on June 12th was 136 million yuan, about half of that in the same period in 2019, marking an 8-year low. Just again, more data points, small ones here and there, but again, they aggregate into something much bigger and a bigger problem. And this just gives you a quick backdrop of industrial production in May, year on year, up 8.8%, year average 6.6%, retail sales at 2-year 4.5%, fixed investment 2-year average 4.2%. Remember, the economy is supposed to grow in China at least 6%. And two big, gigantic pieces to that are well off of 6%. So you need everything else to be more than 6% to pull that average back to this elevated level, which continues to be an overarching issue. And again, speaking to not just India and China, but export prices at South Korea continue to surge higher and coming closer. And just given the issues that we're seeing, the problems, as we said in the very first segment, when we talked about Chinese delays, China softness, China problems in Guangdong, COVID issues, electricity issues, rolling brownouts, all of these things are going to culminate because South Korea imports semi-finished goods from China. There's some pivot back and forth, which means that they're going to have to go elsewhere to find it, increasing total prices, underlying prices. And that is leading to, as we said in the first segment, an increase in just total container rates, freight rates over the last 5 years. Here's where Shanghai rates are, and they're not paring back anytime soon. So then when you look at foreign currency deposits in commercial banks, foreign currency deposits in Chinese commercial banks have surged over the past year. Now, why is that? By increasing the reserve requirements on foreign exchange deposits, the central bank forces commercial banks to hold foreign exchange on their balance sheet, which could ease upward pressure on the renminbi. Again, they're trying to bring the renminbi under control, and they're trying to shore up balance sheets, so they're forcing companies to hold more foreign reserves on their balance sheet to have that bad debt expense, make sure they can meet any types of shortfalls, create some of those issues because Chinese external debt continues to rise, and it's moving up in a very steady pace, which is, again, creating those issues. When we saw with Yorong and when Huawei and all these other companies that have a large exposure to the international market, and it comes down to, well, what is the likelihood they can pay? And if they can't, how are the banks going to backstop, which is why they need that excess foreign reserves. So when we look at China's internal debt, this just shows you the inherent level of debt to GDP and where does all of that sit. And when you look at just the total levels, central government, local government, a lot of these capacity is the underlying problem because governments are beholden to their local SOEs. They've been incentivized since the early 90s to invest in state-owned enterprises, try to drum up some of this business. And then you can look in 2008 when they went parabolic with trying to stimulate the economy coming out of the great financial recession, trying to get to stimulate the economy, and they never. And then you had that other surge in 16 into 18, and then they tried to cut, panicked in 19, and then obviously 2020 was a world of its own, which is why there's that big driver now to pull this money out of the economy, pull this liquidity out, because if you're running at a debt to GDP ratio of over 250%, you clearly invested poorly because you're not getting a rate of return that makes sense. So then when we look at, again, those China exports to global global PMI. So Chinese exports continuing to move down. We see those orders. We see those slowdowns. That is going to continue to be a huge weight on the PMI. And by a weight, I should say more of an anchor to keeping it from getting to the next level, because China is such a big component of it, from raw materials to semi-finished goods to even finished goods, which is going to complicate the situation, increasing delays in travel. And this is going to be a big one in terms of PPI inflation spikes. In China, you can see that producer price index surged, purchases prices for industrial goods surged, but consumer goods and durable consumer goods have remained flat because the CCP is incentivizing keeping those prices low because they're trying to drive that consumer. They're trying to protect the consumer, drum up that local consumption. And at some point, they're going to have to yield. And I think we're getting very close to that pivot point where they just don't have the capacity, and they're going to have to allow some of these prices to pass through, something similar to what we saw in 2010. And I think what we're going to see, because when you look in 2016 and 2018, it was something very similar. There was tax incentives, there were income tax cuts, there were levy cuts, there were different types of just underlying red tape cost that was removed. And because they're running at a shortfall, they're going to have to increase some income. This is where we're going to start to see that creep back up. They're going to try to bring producer price indexes down, incentivize people locally to buy from storage. And again, that's where we're going to see some of this meat in the middle, but it's going to continue to keep inflation moving higher, which is why China's inflation gap between factories and consumers is the widest since 1993. It's a very different balance sheet. It's a very different country, and they can't run it at this level without seeing some of that pass through, which is going to be an underlying problem, not only just for China, but for international and global growth. When we think of it from an energy perspective and just from a general activity and just market perspective, there's going to be a lot of friction here. So I know we covered a lot. Again, we love the back and forth. We love the questions. Please like, share, subscribe, share this with anyone who you think might benefit. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.